All right, welcome back. Thanks again for watching another video. I've been on hiatus for a while here, for a couple months. A lot going on during the summer. I'm back creating some more videos. So in this one, I'm going to go walk through the tax deductions that are available to those unfortunately hit with the storms these past couple months. Specifically those in North Carolina, Florida, and the southern states. So there's going to be 5 slides, and then I'm going to show you a tax return on how to report all this. And if you filed your 2023 tax return, you can go back and amend it if you want to claim some of these losses. So if you have any questions, leave them in the comments below. Thanks again for watching. All right, so I got 5 slides to show you, and then after that, I'm going to show you the tax return and the tax form and how this all impacts your tax return. So the first slide here, what we're going to cover in this presentation here is just the tax breaks for those that were impacted by Helene, Milton, and other federally declared disasters. What's considered a federally declared disaster? It's when the president has determined that federal assistance under the Robert T. Stafford Disaster Relief Emergency Assistance Act, and you'll see, this get published. So you want to make sure that whatever area that you were impacted, obviously the past, month and a half, there were specific areas that were impacted. But if you're living in another part of the U.S., you were impacted by something else, you want to make sure that it's federally declared disaster. Secondly, individuals can deduct personal losses as a result of these disasters. And I'll show you this tax form that comes up with a calculation, and you got to exclude the amounts that you receive from your insurance companies, and the loss is equal to the smaller of the damaged property tax basis or decline in value less insurance reimbursement. Again, I'll show you this, what the tax form has and the calculation behind it. There are 2 adjustments that come up to your deduction. So you're going to start out with what your loss is, and then you're going to reduce it by $100, and then you're going to look at your AGI. You're going to take 10% of your AGI, and you're going to subtract that from the loss. So if your loss was like $10,000, you're going to remove $100. So now you're at $9,900. Then you look at your AGI. You multiply that by 10%. Whatever that amount is, you subtract it from that $9,900 example I just said, and the difference between the two is what your deduction is. Again, I'm going to show you with using other numbers what this is all going to look like. Now, for those that were impacted recently here in 2024, yesterday, October 15, 2024, was the filing tax deadline, and you were obviously extended if you haven't filed yours. If you were impacted here in 2024, you're allowed to go back to the 2023 tax year, amend it, and claim this deduction. So what you're going to have to do is go back, amend it. You're going to file a 1040X, which is the amended federal tax form. So you don't have to wait until next year to kind of claim these losses when you file your 2024 return. You can kind of go back and amend 2023. And then finally here, this tax form. So it's tax form 4684. This is where you report the gains and losses from casualties and thefts. You're going to attach this to your tax return. And then, most importantly here is who's eligible for this deduction. Those people that itemize or take the standard deduction. With this tax break here, it's for those that itemize. And I'll show that to you on this example tax return. So keep it pretty simple here. There's probably other benefits out there, but this is one that you want to make sure that you're claiming on your tax return. If you have any questions, leave them in the comments below. Thanks. All right, so let's take a look at a tax return here. And before we kind of go into this 4684, I want to show you page 1 here, just to kind of cover some terminology. So first off, you noted I mentioned AGI, or adjusted gross income, and this is an example tax return. This is always like an important number. It's an important metric to kind of come up with certain deductions and phase outs. So you want to know what that number is always when you kind of work on your tax return. So in this example, it's $267,000. And then I mention the standard or itemize. So you can see here, this couple here, they itemized, and I'll show you Schedule A. For the standard deduction, it's a lower amount. So for them, taking the itemized deduction is more beneficial. Now with this disaster deduction, if you take the standard deduction, you can't get this deduction. But it might put you over the edge, and I'll show you where that comes into effect here. So let's go to Schedule A here, the itemized schedule. So the itemized schedule typically are those that own a home, right? Because they have mortgage interest. So in this example, they've paid $25,000 of mortgage interest. That's a big component of Schedule A. Another big component is taxes that you paid into the state for payroll, in real estate taxes, but it's capped at $10,000. So the most you can get from here is $10,000. If you have medical expenses, you can deduct those here, but you can see here, again, going back to your AGI, here's their AGI, and for medical expenses, it starts at 7.5% of your AGI. So you would have to have more than $20,000 of medical expenses just to get $1 of deduction. So that's where that AGI number comes in. And I rarely see people kind of getting this. So you got the taxes paid, and you got your mortgage interest. Then you get the casualty and losses right here. Okay. And you can see for them, their amount is $23,000. So when you add all these numbers up in this last column here, for them, their itemization deduction is at $58,000. So when you did your 23 personal return, you may have some mortgage interest, and maybe it was only, $7,000. You had your taxes at 10, and that was it. And when you took the standard versus itemized, maybe for you, the standard was higher, right? So you didn't itemize. But now let's go down to the casualty and loss tax form, because by doing this might put you over the edge where now you are itemizing. So you kind of complete the form here. You kind of know, what the type of property, equipment, or whatever was damaged. You put the cost value here of the property, and then you put the fair market value before the incident happened. So in this case, the fair market value was $60,000. Then you kind of put with the fair market value after the incident, right? So just say I'm making this up here, a vehicle, right? You had a vehicle, the fair market value before the storms, it was $60,000. Fair market value after the storm, it was $10,000. So your loss right now is $50,000, and that's what we're kind of working with here. But you can see here, insurance and other reimbursements, you got to factor that in. So if you didn't get any insurance reimbursements, which was the case here, that's what it's going to show. But if you did, that's going to impact the loss here that you're going to report. So it's obviously going to be a lot less if you received any insurance reimbursements. So our starting point here is now $50,000 loss. Remember, I'd mentioned two deductions or two adjustments to that amount. The first one is you got to reduce it by $100. So now we're down to $49,900. The next adjustment is we have to reduce it by 10% of our adjusted gross income. So remember, our adjusted gross income, let's go back page 1 here. Our adjusted gross income, AGI, was $267. 10% of that is $26,743. So let's go back to this casualties and theft page. There's that $26,743. We take this new loss, subtract it by that, and now we're down to that $23,156. And then that's going to show up on Schedule A, your itemize, $23,156. That's where it shows up. So again, even if you didn't itemize, but you had losses and insurance isn't paying you out or reimbursing you, you may want to go back, because you may, even if you took the standard deduction, by claiming, you might have a large, based on losses I've been hearing, you might have a large enough loss where you can kind of claim that, and that will put you in itemized, and that will get you a bigger kind of deduction on your overall return. So that's it. If you have any questions, leave them in the comments below. Thanks again for watching.